Welcome back. Well, we're continuing the coverage of what's been another disastrous day on the street. Still down about 4% on the indices. Nifty slightly better off now, actually, 3.5%. It'll be interesting to see the flows picture. Have domestic buyers chosen to come in and use these attractive levels to buy in? Jigar Mistry is with us, so let's get some thoughts in. Jigar, thanks so much for joining in. That's my simple question to you. I mean, a lot of retail investors have become so resilient, right? They don't get broken. But this is a new normal, so to speak. So here, what would your advice be? Some chartists we just spoke to saying that even the June 4 low, the election day result low, it's not sacrosanct. This thing can head lower. We don't know. So what would you advise?
So I think, let's break it down in two parts. One, what's really happened. And since morning, I'm sure you have heard dozens of opinions on how that has transpired. And towards the second part, I'll actually relay some numbers. Right. So first, obviously, two ways to think about it. We can always say this is all just posturing, and eventually this is a way to get a lot of countries on the negotiating table. And if that is the case, then this is a great buying opportunity, part of a recognizable pattern, and things will be normal pretty soon. The other part is obviously what I think a large variety of stock market experts are bringing out is that what if it is changing the global order, right? 50 years, like post 1971, when gold was no longer the reserve currency. Post that, dollar has been the backbone of everything else. And 25 years of global disinflation once China came into WTO. And if you're appending all of that, then what really happens? Now, surprisingly, Stephen Miller, who is the chair of the Council of Economic Advisors to the Trump administration, when he was with Hudson Bay Capital, he had put out a paper in November 2024, where he had given a complete toolkit of how they intend to orchestrate, sort of what I call shrinking the empire. Global sort of military security is no longer a leadership sign. It's a liability, and we need to back off from that. And essentially the Triffin dilemma, where you keep supplying dollars to feed global savings, no longer need to happen. And if that is the case, then I would think nobody really knows how this transpires. And it is that uncertainty rather than, what really is going to happen. The worst case could not be worse off from here. But it's that uncertainty which I think is troubling a lot of people, in which case we just need to sort of wait and watch on how this plays through. Now, to the second part of your question on how does this stack up with numbers, so I'll give you a very clear picture here, right? So if you looked at say a 5-year or a 10-year rolling return, it might surprise you that the EPS and share price growth, whatever index you take, and companies with long enough trading history, the numbers always align. By September 24, however, the small cap index earnings growth on a 3-year CAGR was 14%. The share price growth was 26%. So there was a 12% compounded, for the lack of a better word, froth for 3 years that was built in. And, that's a 35, 36 odd percent that needed to be taken out. If in 5 years EPS and share price always aligns, and we are sitting on a 30% froth, that could either be erased if the index were to remain flat and earnings grew for a couple of years, or the index fell 15% for a year and earnings grew for a year, or as it's transpired, earnings sort of markets fell 20-25% on day zero, and essentially that has brought the entire market into equilibrium. The only point we now need to consider is that when you pulled the sort of pendulum so far to the right, does it actually stop at the equilibrium, or it needs to go in the other direction for the equilibrium to establish in and of itself? So I think some amount of corrections, a lot of stocks could then come into reasonably decent pricing potential. Obviously, as I said, the caveat is that we need to see if they are not really trying to upend the global order.
Jigar, sorry to come in over there. We're just trying to squeeze more questions. So short point is, are you buying now or no? Have you bought today? Or is it better to keep the powder dry?
Very small. So you remember, right, September, October onwards, we have kept crying that the valuation stocks are not making a lot of sense. And therefore, we were extremely defensive. January, February, when the markets fell, was a reasonably good time for buoyant capital as a fund, relatively speaking, obviously. And we were still sitting on a reasonable amount of cash. We are not deploying very aggressively. I think we have taken sort of just a few positions today. But I think next few days, if the things continue to remain very bad, then we will we will get into it as we speak.
Okay, all right. Jigar, what are you all buying though? As you said, you're deploying some money. So if you have to buy and if things don't get much worse from here, what's the sector that stands out for you?
Nigel, so basically, obviously the sectors, now obviously this is the first order impact, right? When I mentioned that India is relatively better placed with inward-looking sort of inward-looking economy, then obviously sectors that are inward-looking, to some extent, banking connections are not that wild. Cement is very interesting. So all those sectors, pharmaceuticals, I don't think there is a big impact there. Obviously currently exempted, but even later, we don't think there is a big impact there. So those are the sort of sectors that we like currently.
Jigar, what you'll purchase right now is from the cash, your existing cash holdings. What about the clients whose money you're managing? Are they willing to buy the dip right now? Are you getting inflows right now? You know, that's the first point. And then come in on tech, because I remember a couple of months back, you were a bit bullish on large cap tech names like an Infosys, HCL Tech.
Right. So yes, continue to get a lot of flows. Obviously, sort of this is part of the communications that we were having, that eventually we don't know what triggers a fall, right? Because until 6 months back, the whole idea was that you will, the domestic flows are so strong that even if FIs turn seller, it will largely impact only large caps. And it doesn't sort of matter why, where or why the small caps would function. And therefore, you should keep buying small caps. And then the argument was that, we'll only know the trigger in hindsight. It is very difficult to make up what has actually transpired over the past couple of days. But because of that, I think we were sitting on war chest even at the client levels. And I think some of that is flowing our way as we speak. On the second part, no, tech remains not really sort of, if I remove a couple of stocks which are fintech, then tech for us is nearly zero.
Okay, all right. And Jigar, stay away from metals, right, in global uncertainty?
No, Nigel, I think the only thing that looks interesting here, because see, even if dollar depreciates, everybody needs to de-dollarize in certain ways, right? So metals could look greener. Probably the only other thing on a lighter vein in the market today is the green jacket that you are wearing, and metals could join that.
And within metals, what do you like?
Non-ferrous, I think, is rather interesting. So there's one company that we own there.
The one that's going for the special situation?
Yes.
Got it. Okay, all right, Jigar. In fact, before you joined in, I put out a piece that maybe steel could be relatively better placed because of domestic facing theme. But as you're saying, you prefer non-ferrous, and out there, the one that's going for a special situation, only one thought comes to mind, which is Vedanta. Time for our special segment, D Street Chatter. Nimesh joins us to help us out with what he's picking up. Nimesh,